Election night stuff, there were violent reactions, including in the 30-year for the treasuries and equities futures, and then they settled down. Actually, the equities kind of liked it overall over the course of the week.
We think that there are two drivers that have driven the market this week. One, election-related. The mere fact that we don't have uncertainty anymore, that the election actually occurred and the process was generally smooth, was important. Second, I think in terms of the fact that you have mentioned this as well, that it was 50-50 split, very close everywhere. So there's a strong signal that policymakers should not go too far to the left or too far to the right, that the markets won't like that, and the electorate, with such incredible participation, confirms that they don't want extreme policies, and most importantly, divided government. If we go back to 1928, or we just look at the post-World War II period, returns, both for equities and bonds, during periods of divided government are close to double that of single-party government. So the markets, the financial markets, do not also like extreme policies. So that's a perspective in terms of looking at the election results. And then from a fundamental perspective, we've had 83% of U.S. Stocks at the S&P 500 reporting earnings exceeding expectations, both on revenues and on earnings. So very solid fundamentals. We had the third quarter GDP number at 33+%. So very strong momentum going into the fourth quarter, helping offset some of the risks that we're going to have with the surge in infections. So that's very important. And then in addition, we just had the non-farm payroll numbers and claims yesterday. So very good support there, and incredible decline in the unemployment rate with an increase in participation. So very good generally.
So Beth, you follow labor economics in particular. In addition to the election this week and the Federal Reserve, we also had some jobs numbers that were pretty encouraging, actually, better than had been expected. How much help does the labor market really need from either the Congress or the administration at this point?
I'd say as much as it can get. I saw a lot of people starting to celebrate the good report that we had today, and were quickly mobbed by economists who wanted to remind them that while this was good news today, we are not in a good labor market. So as Professor Hubbard pointed out in the earlier segment, we lost 20 million jobs at the onset of the pandemic, and then we have begun to crawl out of that hole. We've gotten about halfway out. 10 million more jobs is a long way to go. And it's especially a long way to go when you realize that a lot of the people who have come back into employment at the early stages of, I guess, what we could call a recovery, are people who return to the same job that they were temporarily laid off from. A lot of the people that we're seeing who remain unemployed today were completely separated from a job. And so, as you can imagine, it's going to be harder to get this population back to work. So I think a lot of support is needed, and I'm advocating for legislation myself.
So we may need a lot of support on the labor market, but Sharmin, do we need a lot of support for the other markets? Because as a practical matter, it looks like if we don't have too many taxes, it's not too disruptive, it's sort of Goldilocks, sort of just right in the middle, particularly when you have low interest rates, it makes equities worth a lot.
I think there's no doubt that we need some support as we get through the continued acute phase of the pandemic. And we know with the surge that we've seen in numbers, not just in the U.S., but in other parts of the world, we're going to have a very difficult November and December in terms of infections and what that means for the economy. If you look at high frequency data, whether you're looking at Google mobility data, Apple mobility data, TSA travel, open table data, you are seeing a flattening of that improvement. So the next several months will be tough. But the assumption is that if we get a vaccine and these therapeutics sometime in the first quarter of the year that have some level of efficacy, no doubt that none of these are going to be magic bullets. But if you have something that's going to help, then you'll need some support, but gradually the unemployment rate will improve. If you think of our forecast for 7% by the end of the year, we already got it. So the glass is more than half full than it is empty.
So Beth, briefly here, I'll give you the last word. Is it going to be even rougher in the labor market? Because we didn't bring all those 10 million people back, and if in fact we have to shut down some more, it's going to be worse.
Well, the good news is that we had a good bump this month, which sets us at a higher level for any potential deterioration in the coming months as the pandemic potentially gets worse. I would say we're in for a long winter, both with the pandemic and the labor market, quite unfortunately.